Hey everyone, it's Daniel here from Refinance. Hope you're all doing well. Just want to talk about this article that comes from CNBC. I will post the link in the description for you to basically take a look at it. But basically, it comes out and it says that, hey, mortgage refinance demand has increased by 6%. It was basically a very big increase when you compare last month to this month. However, it's still down year to date, but showing signs that a little bit of demand has come into the mortgage towards a lot of these mortgage companies start to see a pickup where people are now thinking to refinance their home, given the little bit of a pullback in the mortgage rates. Now, why did the mortgage rates pull back? Right? The reason is because we saw a big rally, a big move up in the long dated bonds where the prices moved up and the yields kind of eased up. Why did that happen? That happened because inflation expectations down the road, investors and traders are thinking that we probably see inflation come down here in the coming year or so. And because of that, we saw the long end bond move up and the yields come down. The other thing that is being priced into the market is fears of recession also. So that is also creating the softening in the yields. The fact that the market is waiting for this Fed pivot and waiting for rate cuts to come. That also played into the softening in the mortgage rates. Now, this is just a preview of what things can look like, especially in the housing market, especially in when it comes to mortgage demand. Especially if the Fed really decides to pivot. Now, what's the pivot? The pivot is to go from rate hikes to rate cuts. Now, if they start cutting rates, then sure, you could probably see a pickup where people will go out and get their mortgages, get refinance, or do whatever they have to do in order to go and start buying houses again. And the demand would also pick up. Now, is this report, right, this increase in demand, is this telling us that the market is now getting better? Now be careful, right? Just because a little bit of a pickup in the mortgage refinancing demand, just because there's a little bit of pickup doesn't mean that we're out of the woods completely. We still got all of 2023. We still got all of the effects of tightening that we've done this year to be shown next year. We still got to see how earnings are next year, how a lot of companies end up managing their expenses, whether they're going to lay off more employees, and much more for the next year. And I think that next year we're going to see this kind of rude awakening, which I've been talking about, where a lot of people and businesses will start to feel the pain of all the tightening that the Federal Reserve and the central banks are doing globally, worldwide this year. We will feel that next year, right? Everything that we've done in 2021. Because if you think about it, in 2020, with all the money printing, the rate cuts, we saw the result of that in 2021. Now all the basically QT, quantitative tightening, and the rate hikes that we've done in 2022, probably will see the results of that in 2023. Now, another thing that you want to notice is that the Federal Reserve in 2021 was basically coming out every single time and saying that inflation is transitory. And they ended up being wrong. And then finally, at the end of 2021, they started to give signals that they're ready to flip and ready to tighten and raise rates, which they did. And they did aggressively. And they were completely wrong about it. This time in 2022, at the end of this year, the Fed came out and said we're raising rates to 5.1%, and we continued to raise rates depending on the data and we continue to be hawkish. We continue to want to see that the jobs the labor market is easing, and the labor market is um, basically, in other words, let me put it in very simple words. The labor market is going to be worse off for 2023, basically because he wants to see wages come down so inflation can come down. And he mentioned Federal Reserve Jerome Powell, the head of the Fed. He basically mentioned that, yes, we want to continue with the rate hikes. We are going to slow down the pace, but doesn't mean that we're done with rate hikes, doesn't mean that we're done with tightening. We do want to see this pain that he's expecting in the economy, in the markets, to bring inflation down. So we have yet to see that. And why I bring up 2021 versus this year is because of how wrong Jerome Powell was and the Fed was in 2021 about saying inflation being transitory. And then again, we're seeing today, we do see some signs of inflation come off. We are seeing some pain in the markets and in the labor markets and for a lot of people and businesses, but we still have the Fed coming out and saying that things are good. Labor market is still strong. We still need more pain. Still need more pain. Inflation could continue to go higher, which is why he continues to be hawkish and remains hawkish until probably when that flip will happen, probably when something really truly breaks. So until then, we'll have to see what happens. And until then, probably, we won't see a pickup in demand for housing or assets until really something does break and he does do the pivot that everybody's waiting for and the flip, which is doing QE and cutting rates all over again. So we'll see what happens. Leave a comment below. Let me know what you guys think. Hit the subscribe, like button as well, and I'll see you guys around. Cheers.